Welcome to Inside East African Politics, and welcome to the Deep Dive. Today, we're focusing on Kenya. There's a really high-stakes decision unfolding that could, well, dramatically reshape its economic landscape. We're digging into the potential sale of a significant chunk of the Kenyan government's stake in Safaricom.
Right, and we've looked through that stack of articles, research, and the notes you shared. Our mission today really is to unpack what this incredibly complex decision truly means. Is it, a necessary strategic move for Kenya's future? Or is it a risky bet that could sacrifice a key national asset?
Absolutely. And before we jump into the why now, I think it's crucial we all grasp the sheer scale of Safaricom. Look, this isn't just another telecom company in Kenya. It's deeply, deeply woven into the fabric of daily life there.
It really is. I mean, just take M-Pesa, their mobile money service.
Exactly. It processes transactions equal to something like, 55% of Kenya's entire GDP every year. It's staggering. Some research even credits it with helping lift nearly 200,000 households out of extreme poverty.
It's a massive economic engine, no question. Contributes over 8% to Kenya's GDP. Supports over 1.2 million jobs through its whole ecosystem. So when a single company is that integrated, any change in ownership, well, it becomes a matter of national strategic importance. It's way beyond just a business deal.
Okay, so let's briefly touch on the history. Safaricom started out as part of Telecom Kenya, right? Then Vodafone got involved, later Vodacom. Its growth really took off then. And a key moment was that 2008 IPO, the initial public offering.
That's when they first sold shares to the public, yeah. About 25% was sold off then. And financially. Look, it's an absolute powerhouse, consistently the top earner in East and Central Africa.
The numbers are pretty impressive. For the financial year ending March 2025, total revenue was around $3 billion.
Something like that, yeah. And net income about $540 million. And M-Pesa, as you said, is just central, bringing in over 44% of their service revenue. And we shouldn't forget the Ethiopia expansion. That's looking promising, already contributing almost 10% of the group's revenue.
So the Kenyan government still holds a very significant piece, 34.9%, let's call it 35%. And its value is considerable, maybe $2.1 to $2.2 billion, roughly. Crucially, it provides a stable income stream to the government through dividends.
A very stable stream.
Yeah.
In 2024 alone, the government got, $130.5 million in dividends?
That's right. That's not pocket change by any stretch of the imagination.
No, it's a really significant source of non-tax revenue for them, which of course immediately raises the question, why on earth would you consider selling such a valuable income-generating asset right now?
And that is the critical why behind this potential sale. What the sources really hammer home is the driving force. It's intense fiscal pressure, and a truly, truly soaring national debt burden. I was pretty struck by the figures on the debt payments themselves. How bad is it, according to the sources?
They paint a pretty stark picture. Between July 2023 and February 2024, just that period, Kenya spent $5.5 billion just on interest payments for its debt.
Wow, $5.5 billion.
Yeah. And get this, that's over half of their total tax income collected during the entire period. Over half just servicing debt. And the projections. They suggest interest payments could even top $7.7 billion by the end of the year. That's a huge chunk of change not going to public services or development.
That kind of pressure explains the urgent need for cash. The government's goal, stated explicitly in the sources, is to raise KSH $149 billion. That's about $1.16 billion in the next fiscal year through privatization. The stated aim: plug budget deficits and, crucially, avoid politically toxic new taxes.
Right. Avoiding new taxes is always a powerful political motivator, isn't it? And when you look around at what the state owns, Treasury Cabinet Secretary John Mbadi is quoted basically saying Safaricom is one of the few robust, profitable public assets that can generate this kind of cash. Unlike, many other state-owned firms that might be losing money, Safaricom is a reliable cash cow.
What's really interesting here, though, is how the sources frame this. It feels less like a thought-out long-term privatization strategy and more like a reactive measure to an immediate, very pressing fiscal crisis, specifically needing cash for those massive debt payments.
Exactly. The urgency, especially the link to avoiding new taxes, it points towards a political need that might prioritize speed over, say, getting the absolute maximum value for the shares. Some sources even use the term, or suggest it feels like, a potential fire sale.
You've hit on a key point there. Relying on selling off a highly profitable asset like Safaricom just to cover debt servicing, it does seem to highlight maybe a deeper structural issue, perhaps a lack of, fiscal discipline over time, or maybe not enough diversified revenue streams for the government.
It's a bit like selling the valuable family home that brings in steady rent, those Safaricom dividends, just to pay off your high-interest credit card bills, those huge interest payments.
Yeah, it gives you immediate relief from the credit card company, sure, but you've lost that future rental income stream. It really raises that big question about long-term sustainability. What happens next year or the year after if the underlying reasons for the debt, maybe government spending, maybe inefficiencies elsewhere, aren't actually fixed?
Precisely. And that takes us straight into the potential downsides, the risks and concerns that the sources raise the negative case for doing this.
Okay, so the most immediate, most obvious risk, losing that stable, significant annual dividend income. We just mentioned it, over $130 million in 2024. Selling shares means giving up a slice of that recurring income. The one-off cash injection helps with today's debt, yes, but it removes a consistent revenue source that could support the budget year after year. Like you said, there's a potential fiscal cliff down the road if the cash is spent and the debt drivers remain.
Then there's the whole issue around losing strategic control or influence. Safaricom isn't just pipes and wires. It's fundamental to Kenya's digital infrastructure. It owns critical assets and is planning big future investments. Like that $500 million pledged for AI infrastructure across East Africa over the next 3 years. Things like data centers, digital skills training.
And M-Pesa, its role is just so pervasive. It's not just payments anymore, is it? It's this whole ecosystem paying bills, savings, loans. The sources mentioned Filiza, their overdraft service, dispersed something like KES 981 billion in 2025 alone. That's massive reach.
It really is. So the concern is, if the government reduces its stake, does that dilute public influence over where this key technology goes, over digital inclusion efforts that affect millions?
Yeah, does it shift the balance too much? If government influence shrinks and, private profit motives become even more dominant, what happens to consumer protection or in ensuring universal access, especially for rural communities?
Those are valid questions. And then there are the market risks too, right?
Definitely. Even though the stock's done okay recently, I think the source is set up about 16.4% year-to-date in 2025. Around KES 19.85, Telecom stocks can be volatile. There's always a risk of selling too low, especially if the market thinks the government needs the cash quickly. That perception can hurt the price. Plus, selling a huge block of shares like this can itself push the market price down. Getting the best value isn't simple. Maybe you need a private deal to get a premium, but that's not guaranteed.
And thinking about these downsides, it's really worth looking at history. What can experiences elsewhere, particularly in Africa, teach us about the pitfalls of telecom privatization? The sources do flag some cautionary tales.
Absolutely. Unfortunately, many past privatizations across the continent struggled or frankly failed. The reasons vary: lack of commercial viability sometimes, political issues, legal problems, public opposition, even corruption.
Nigeria's Nitel is one example mentioned. It sort of limped along for a decade after privatization attempts and eventually just folded in 2014, buried under debt. The sources also point to warnings from Ethiopia's experience with Ethio Telecom, suggesting that, if it's not managed carefully, privatization can lead to things like the new owners underinvesting, raising prices for consumers, service quality dropping, job cuts, and maybe just swapping a public monopoly for a private one without really creating the competition that benefit people.
There's even that broader critique you see in some analyses that poorly handled privatizations can end up feeling a bit like, quote, recolonialization by corporations, where the focus shifts entirely to shareholder profit, potentially sidelining public good, maybe even increasing poverty through job losses or neglecting social welfare. These examples really hammer home the need for incredibly careful planning, transparency, and strong regulation.
So, okay, we've laid out the urgent why and these significant potential risks. But despite those risks, there is a positive case being made. There are potential opportunities and benefits the sources also explore.
Right. The number one benefit, the most immediate one, is clear. Raising that KSH 149 billion, the $1.16 billion target. That would significantly ease the pressure from those crippling debt repayments. It helps plug the budget gap without resorting to those politically difficult new taxes. That's a huge potential win politically. And that immediate cash could possibly free up funds for other things like infrastructure or development projects.
And the potential yield from Safaricom alone is substantial. The sources estimate selling just 5% could bring in around $308 million. A 10% stake? Maybe $617 million. So you can see how selling a portion of Safaricom could provide a really big chunk of that overall privatization target.
Beyond the cash itself, there's an argument that a smaller government stake could actually encourage more private investment. and potentially drive more innovation and efficiency within Safaricom, attracting big global investors, private equity, institutional funds that can bring new expertise, maybe improve corporate governance, and still more market discipline.
And that focus on efficiency and market discipline could, theoretically, make Safaricom even more competitive, which might, down the line, benefit consumers through better services or maybe even lower costs, although, as we said, good regulation is absolutely key there. There's also a strategic angle the sources mention, how this sale could signal broader reform and attract capital beyond just telecoms.
Yeah, that's interesting. It could boost confidence in Kenya's overall fiscal management. That's really important, especially for meeting targets set with institutions like the IMF. And maybe it revives Kenya's privatization program, which has been stalled for a while, signaling a renewed commitment to market-led growth, aiming to pull in more foreign direct investment, FDI, across the whole economy.
Exactly. Selling a highly attractive, profitable asset like Safaricom, especially when other state companies might be struggling, it sends a powerful message. It tells international investors, look, Kenya is serious about fiscal reform, about reducing the state's role, about creating an attractive climate for private capital. That kind of signal could potentially lead to better credit ratings for the country, maybe lower borrowing costs in the future, and more FDI flowing into other sectors too.
And just like there are cautionary tales, history also offers some potential success stories with telecom privatization in Africa.
Right. The sources mention Nigeria's telecom sector privatization again, but this time as a positive. It led to huge jumps in mobile phone access, lower costs for users, big investment in infrastructure, and it boosted GDP growth and created jobs.
And South Africa's partial privatization of telecom back in 2003 is another example cited. It raised about $500 million then, signaled commitment to reform, attracted foreign investment, and came with promises of infrastructure expansion.
But, and this is the really crucial caveat, that the sources stress while privatization can bring these benefits, efficiency, capital, signaling, success hinges critically on having strong regulatory frameworks in place. You absolutely need a clear strategy to avoid just replacing a public monopoly with an unregulated private one, especially in a sector as vital as telecoms.
That's the key takeaway, isn't it? Positive outcomes aren't automatic. They depend on getting the conditions right. For Kenya, that means ensuring the regulators are strong, independent, and really empowered to foster competition, protect consumers, and guide how the market develops after any government stake sale. The focus shifts, really, from just selling shares to the critical importance of governance and regulation post-sale.
So if we pull all these threads together, what we're looking at is Kenya facing a classic, really high-stakes economic trade-off. On one side, immediate fiscal relief, addressing that crushing debt, avoiding unpopular taxes. On the other side, preserving a long-term strategic asset, holding on to that stable dividend income, maintaining influence over critical digital infrastructure and future tech development. It's that tension, immediate cash versus long-term strategic value.
And it's clear this decision isn't just about economics. It's deeply political, it's ideological, as the sources really highlight. And maybe unsurprisingly, expert opinions on the best way forward seem sharply divided.
Absolutely. You see voices like Ephraim Menjega, a policy analyst mentioned in the material. He supports strategic asset sales, seeing them as pragmatic fiscal solutions better, he argues, than taking on more expensive debt like Eurobonds. He views it as a necessary step given the current fiscal reality.
But then, conversely, you have someone like Kevin M.K. described as a fiscal policy critic. He voices serious concern, warning the sale might end up being futile if the underlying problems, government spending habits, patronage networks, inefficiency, aren't tackled fundamentally. He worries the money will just, paper over the cracks for a little while.
Then there are other perspectives. Ambrose Ogomber apparently views divestment as ideologically sound, reflecting a belief that the state should retreat from market activity, aligning with free market ideas, potentially spurring private sector growth.
While someone like Chage Mundia voices deeper concerns about sustainability, arguing that selling off strategic, profitable assets just to cover short-term budget holes leaves Kenya more vulnerable and less resilient when the next economic crisis hits.
This range of opinions really underscores that the whole debate touches on fundamental questions, doesn't it? What is the proper role of the state in the economy today? What does fiscal responsibility truly mean in this specific context? How do you balance national sovereignty over strategic assets against the need to attract private capital and modernize? What's Kenya's long-term development vision, and how does owning or not owning its key infrastructure fit into that?
It's definitely not just a numbers game. It's about core values, national priorities, and the kind of economic future Kenya is trying to chart for itself. Whatever decision they ultimately make about Safaricom, it seems likely to define Kenya's economic philosophy and trajectory for years. It'll impact government finances, yes, but also potentially the social contract and the country's standing on the global stage.
So as Kenya weighs these options, that choice is stark. Sell for the immediate relief it offers, or hold on for that long-term strategic value. The tension is palpable.
Which leaves us with a final thought, maybe building on what the sources suggest. Given just how deeply Safaricom is integrated into Kenya's economy, its society, its digital future, is relying on selling parts of it to solve immediate debt problems, a necessary pragmatic evil in a very tough spot? Or does it risk fundamentally undermining the very foundations, the future growth, the digital progress that it's ultimately trying to protect?
That really is the multi-billion-dollar question, isn't it?
Thanks for diving deep with us today into this absolutely critical issue facing